tax avoidance is a skill, and tax evasion is a crime, right? It's illegal, right? But yeah, he or she is actually correct, right? Tax avoidance is allowed, all right? Is allowed, but tax evasion is actually illegal, and you could actually face imprisonment for that. All right. So say if you want to avoid tax, before we get into it, remember this is not tax advice. This is not legal advice. This is just for your own information. All right. I just want to actually show you something that you can actually do. But if you want tax advice or anything of that sort, talk to your financial planner, talk to your tax planner, talk to your wealth planner, talk to your tax practitioner or your accountant, people who are actually seasoned and who are trained to actually get into these arrangements. All right. So what you can do, let's say if you want to buy a house that is worth, let's say 2 million. All right. You want to buy a house that is worth 2 million. All right. All right. For you to avoid, to afford a house that is worth this amount, chances are it should be in a it should be situated in an area that is proper, that is good, and if it is an area that is proper, all right, if it's a good area for residential property to actually accumulate in value, chances are maybe it could be a suburb or maybe a new development that is going to be turned into a suburb or something. All right. So it means property taxes are going to be very high, right? Property taxes are going to be they are going to be high. All right. Property taxes are going to be high. We're looking at things like your electricity costs. They are also going to be very high. All right, very high. Water also included. They are going to be very high. All right. They're going to be very high. All right. So if you want to avoid tax, all right, the first thing that you can do, you can actually register a company. All right, register a company. If you register a company, even if it hasn't made any profit, doesn't have any transaction, you can actually use this company to buy a house. All right, get into a bond agreement with a bank or financial institution, register a company, and use this company to buy your primary residence. All right, you use this company to buy. I don't know if you can see this side, your primary residence. All right, that is going to cost you 2 million. All right. So if you want to use the company to buy this residence, the first thing that the banks or the financial institutions will look at, they want to know the rental. Is there a guaranteed rental for this company? For this, if you're going to use it for the company, are the rentals guaranteed? All right. All right. If the rentals are guaranteed, then it means there will be inflow, even if the rental amount is not enough to cover the total installment. Because remember, you'll be standing in as a surety. All right, you'll be standing in as a surety. So should anything happen, if you can't pay, if the business cannot pay the bond, it means you'll be held responsible for this loan. So what you can do, you can enter into an agreement with your company to say, okay, my company, I am working, I am credit worthy. That is why I can actually afford to buy a house of this amount. So I am credit worthy and I can afford to pay rentals, rentals of about let's say 25,000 per month. So if your installment was supposed to be 20,000 per month, it means you definitely can afford to stay actually in this property through a rental. So you draw up a proper rental agreement between you and the company. So you will be you become the tenant to your own company. So it means when you become a tenant to your own company, the company has guaranteed income, and you will be using this for your family. So even the financial institution will see that, okay, this person is actually buying this for a family, and it's guaranteed. We can see his salary. It's a lot of money. I mean, for you to afford a house that is worth 2 million or more, chances are you are on the last bracket or something, and the last bracket we're looking at 45%. And remember, for companies, company tax for the company, it's only 27%. All right. The current tax for the company is 27%. So this is what you are going to be doing, all right? Instead of, so if the installment for this thing, for your bond is 20,000 per month, what I want you to do is you don't pay the rental of 20,000. You pay, let's say, 19,500, all right? You pay 19,500 on a monthly basis, because I can tell you on the first 5 years you're going to create a loss, because the chances are out of the shortfall of about 500 on a monthly basis, all right? But they know that you are obviously going to be able to cover for this through other means. So you, as the owner of the company, you will be transferring that extra 500 into the company so that it can cover the installment, because I mean you're only paying an income of 19,500. This 500 that you are paying, we can actually take it also as capital contribution to your company, right? It's not the rental, it's not the rental amount. This one will represent rental income to your company, all right? But out of this rental income, I can tell you, chances are you'll be paying maybe 17,000 out of this installment, 17,500 interest. And 17,500 interest on a monthly basis is a lot of money, all right? If you multiply it by 12, you are going to be able to deduct that. Remember, if you are buying this property without putting it under the company name, you're actually not going to be allowed to deduct property taxes, property rates and taxes, water and electricity, and including interest and bank charges. But now that it's under the company, you can actually deduct these things. So it means the company will actually be creating a loss. I mean, property, let's say all of these expenses, if it's an area that is well established, looking at about let's say maybe 5,000 per month, all right? So you're looking at about 60,000, extra 60,000. So you could actually be making a loss of maybe 70,000 on an annual scale for this company. And if you are making a loss of that amount, you will probably get a refund, a tax refund. Or if you don't want to get a tax refund, what you can do is you can take this and carry it forward to the next year, so that it can actually deduct from your future profits. And remember, I said in the first 5 years, the interest will assist you to actually create a loss. Chances are, as you approach half of the long term, then you are no longer going to be creating a loss because the interest will be going down. But as the interest goes down, in the first 10 years, if this property grows in value, if you're lucky enough, you could actually even double this amount. But let's say the property value after 10 years, it's about 3 million. The excess of this amount, I think the bank would allow you to take 80 to 90% of the excess, which is excess is 1 million, so 80% would be 800,000. So you can take this 800,000, put it into an account where this amount, this 20,000, it gets deducted on a monthly basis. So you take this, you put it into this amount, and this is your equity, remember. So the installments will now be running from the equity. You are not taking anything out of your pocket. At the same time, you basically, this thing is just, I mean, you bought the house with nothing. You are actually staying in a house without paying anything, because you've been deducting all of your expenses. You've been deducting all of these expenses because it's they qualify because they are under a business name. But if they were under your personal name, you were not going to be allowed to actually claim all of these expenses, including interest. And by doing so, you also create a tax loss. And if it's a tax loss, you can actually get a refund or maybe get a, what do we call this thing, or get this thing to actually roll forward to deduct from your future profits. So basically that's how you can actually deduct, avoid tax legally. But for you to actually draw up the structure and manage it properly, you will need tax advice. All right, so this was just an example of what you can actually do if you want to save on taxes. I hope I'm making sense, good people. Thank you very much for watching.